Um, all right. So first time doing Facebook Live, so I hope everything works okay. Um, I wanted to talk about a couple things today. First of all, I wanted to talk about end of year tax planning and kind of what that looks like. So first thing that we have to do generally is we got to figure out where we are in terms of taxes, right? And that means that we need to calculate where that what that looks like, right? Um, and so if we are trying to figure that out, what we'd want to do is get our little handy dandy calculator out. Let's just use an example, right? So let's say that this is Sam. Sam has a recruiting company and he's done it. He's done pretty well this year. He is a single member LLC. He's a single guy. He's not married, doesn't have any kids. So let's make this as simple as possible. Let's say that he has $60,000, right? He made $60,000 in total revenue. All right. Knowing recruiters, we've probably got a 75 to 80% or total margin. When we say all of our expenses are done, like the Crillit, the LinkedIn, any other softwares that we may have, our home office, everything else, we're probably looking at around $48,000, right? That's going to be on a Schedule C. Let's assume that he's a single member LLC, and that he's going to have $48,000 of total net income. Right. The issue here for most business owners and for recruiters in general is going to be the self-employment tax, right? So let's just start with the self-employment tax. There's another little factor that goes in here, but you're going to have to pay $6,782 in self-employment tax. That's the tax alone based off of the amount of income that you've earned for that company, right? So 6,782 bucks. Now, with that $48,000, he's going to have a couple deductions, and one of that is going to be one half of self-employment taxes, which is $3,391.09, right? So we take our 48,000, we subtract $3,391, and we're going to have $44,609 left here to tax, right? Then we're going to take 20% QBI deduction, right? So 44,609 times 0.2, we're going to get a deduction of $8,921. So $44,609 minus $8,921 approximately is $35,688, right? We get a standard deduction, 12,400, right? Now we're down 12,400. Now we're at 23,288 bucks when all said and done, right? That's taxable income. That's what the federal government's going to tax you on. Roughly around 11% effective rate. So I'm just going to use 11% here as a figure. So we're paying $2,561 plus the self-employment tax is 6,782 bucks. So this is the total amount of tax that Sam's going to have to pay on $60,000 worth of income. That's a lot of tax, right? So I wonder how we can take this 6,782 bucks, make it go away, or some of this $2,561 and make that go away. Well, first thing we can do here is we can file a late filing S election. The S Corp is going to take away that self-employment tax, right? First year, we're going to get a knocked off of 6,782 bucks. Generally speaking, we're going to have to pay at least half that, around 3,391 every year going forward. We are going to have to file a separate tax return. So there's some additional costs that you have to consider when you're doing that, but we can basically knock that off completely by doing a late filing S election. So now we're just paying this $2,561 for this year. Okay. So how can we get rid of that? Well, we have $48,000. If we're not paying ourselves any reasonable compensation, really the only retirement option that we have left for us is the traditional IRA. And we have a traditional IRA here because our adjusted gross income is going to be low enough to handle the complete deduction of it, right? But basically, we're going to take that 23,288 bucks, and we're going to be able to subtract another 6,000 for the IRA. So now we're at 17,288 bucks. That times the effective rate of roughly around 11%. So we went from $9,343 to to $1,901. So now we've got a total savings here of $7,441. So that's 7,000, around $7,500 that we're saving by just doing a couple of unique tax strategies. So we have those tax strategies available for us. We also have a couple other things that we can do, right? And most of the time you'll hear this from other people and other accountants. They'll tell you, well, you can defer some cash, right? So if you have a placement that you've made and you've got net 30 on it, well, how about you give the guys another 3 days to go past the January 1st deadline, or maybe another week or so to go past the December 31st deadline. And now all of a sudden it is in the next period, right? If it's in the next period, we're not receiving as much income. We can take that 60,000 bucks and we can push off. Maybe we've got a placement with $20,000 that's coming in. We can push that off into another window, right? Into the next year. And we might pay some more bills down, right? So if we have bills that are outstanding, why don't we just pay those bills? Maybe that will help overall reduce our taxable income. That's going to reduce your self-employment tax. That's going to reduce everything else, right? So there's a couple little things that we can do at the end of the year to try to reduce our taxes. When you look at the total differences there, like if you're buying some equipment or something like that, you might have heard that along the lines for other CPAs at other points of time, buying equipment, right? I would look at buying any purchased equipment that you are buying only for the business. You don't want to go out and just buy things to buy things, right? You want to buy things that are going to be helpful for you in the business and something that you're going to use, right? You get a discount essentially by being able to deduct it. You're going to get a discount, but for the most part, you can't just buy, you shouldn't just buy things to buy things, because that's not going to help your business, right? It needs to be something that's for your business. I would consider it a discount, and that discount is going to be only 11%, right? Well, an adjusted rate for the self-employment tax a little bit too, but there's going to be a slight adjusted rate there as well, right? So that's what we'd be looking at end of year planning, a couple of opportunities that we might have available for ourselves. Yeah. So let's say we got an S corp. If we're in an S corp situation, what other opportunities do we have for ourselves? So let's say we've already saved ourselves that money in the past, right? We've saved ourselves that 6,000 bucks, and now we're at 3,000 something. We've paid ourselves a reasonable compensation of say $20,000 per year. What does that look like, right? How do we get that money down even further? Well, there's a couple of opportunities that are available for you, right? There's the solo 401k. That's a great one for S corp owners. A lot of people's tax accountants, they'll suggest a SEP or a SEP IRA. A SEP IRA is not going to be as effective for you if you have a S corp, and that's going to be because you're going to be limited to the salary that you pay yourself. And the whole goal behind having an S corp is to reduce your total salary, right? And that's basically what we want to do, right? We want to reduce our total salary so we pay less in FICA taxes and less in taxes in general. But that's going to hurt you when it comes to retirement contributions and what you can do there. The solo 401k is going to give you that opportunity to put up to $19,500 on the employee end. So you're going to be automatically allowed up to $19,500 no matter what your salary is. And then you're going to be allowed another 25%. So let's say we paid ourselves a salary of $20,000, right? We've got $19,500 that we can take off. It's going to be a deduction that we can put into our 401k. And then we're going to have an additional 25%, which is 5,000 bucks, right? So we can put a total of $24,500 away on $20,000 worth of salary, right? So we want to look at that and see if that might be an additional component that you can do before the end of the year to totally reduce your overall taxes. We also look at whether or not you've met the reasonable compensation requirements. If you're an S corporation, you have to pay yourself a reasonable compensation, right? There's no gray area there. You have to pay yourself a reasonable compensation. There is a gray area in the amount of reasonable compensation that you have to pay yourself. There's a couple of court cases, if we look way back and way back, that decided kind of what we would pay ourselves in terms of reasonable compensation. All of them involved accountants to some extent. And all of these accountants, they paid themselves a very low salary, and they were taken to court by the IRS. One accountant that that comes into mind. He had 20 years of experience. He made $300,000 in his business, paid himself $30,000 salary. Well, the IRS said, hey, that's unreasonable. So they took him to tax court, and the tax court agreed, yeah, that's unreasonable. But the amount that they made him pay was only $60,000 in terms of reasonable compensation, right? So he had an adjustment on his payroll to $60,000. So you see, it's not really that big of a difference. So we don't really see a lot of IRS litigation between the two, because there's just not, they're not going to make that much out of the time, effort, and energy that they're going to put into trying to adjust your compensation levels. So the big thing is not to be egregious, but to be reasonable, right? But you can be also on the lower end of reasonable. That's what reasonable is. I mean, as long as you're within the reasonable window, you can be on the lower end of it, and that's going to save you a lot of money in terms of FICA taxes. And I guess there's probably some people that don't even understand what I mean in terms of saving money on FICA taxes. So let me just kind of go over that to a certain degree. So we have, like when you were a W-2, if you think back to when you had a W-2, you would have a certain percentage taken out of your check, right? And that percentage was 7.65%. It was a combination of Social Security and Medicare, right? 7.65%. What you know now as an owner, what you may not have known then, is the employer pays another 7.65%, right? So they match the amount of money that's coming out of your payroll. 7.65%. So that comes to a total of 15.3%. And that's what owners pay, and they're forced to pay. It's another tax levied upon you that is above and beyond anything that's going to be there for income tax, right? So let's just throw income tax out the window. Who cares about that right now? The 15.3% tax, that is the biggest tax that you usually have to face as a business owner, because it's a straight tax based off of the amount of income that you make as a business. So that 15%, if we can do things like chop it up, right? If we say, hey, there's an active component of this, and then there's a passive component of it, and only the active component is going to be allocated to that tax bracket. Like, so, I mean, to that specific tax of the FICA taxes, if we can just chop that up, we take your total net income, let's say in our case, for Sam, the $48,000. So he had $48,000 of income. We put it into an S corp, right? No matter what happens, he's going to get income tax on this $48,000, but he's not going to necessarily get self-employment tax on that $48,000, because we pay him a reasonable comp salary of $20,000. So $28,000 is going to come to him on his tax return as a distribution or profit income that is coming from him from his K-1. And then the other $20,000 is going to come to him as a W-2, right? But it's still going to hit his tax return, right? So we're not getting rid of that money right there. But that $20,000, we're going to pay payroll tax on it. Instead of FICA tax, instead of self-employment tax, we're going to pay that FICA tax through payroll. So it's a completely different system. It's not on your individual tax return. When you're a self-employed business owner, all that stuff gets lumped into your individual tax return. So in this case, we want to chop it. We want to put that $20,000 in there. So now instead of paying on $48,000, 0.153 times 0.92, there's just a little factor here that we got to use, $6,782, right? Instead of paying the $6,782, we're going to take $20,000. We're going to only pay 15.3% on it. So we're going to pay a total of $3,060, right? So the difference between what you'd pay as an S corp versus what you'd pay as an LLC is $3,722, right? So you're saving $3,722 every single year that you pay yourself as an S corp or that you have an S corp. There are other costs that are outside of this. So I don't want you to think, hey, well, why isn't everybody an S corp? Why, I make $20,000 a year, why I'm not an S corp? Well, it costs money to run payroll, right? I mean, it's at least $500 a year, right? I would say gusto, $500 a year. That's what you're looking at, right? You're also going to have your S corp tax filing, right? That's usually a little bit more expensive, say about $1,000, right? All right, now we're at $2,222 in total savings. We have unemployment taxes that we're also going to pay, right? Unemployment tax is usually around $300 or so. $300 to $400. So that savings is actually a lot less than you think it is, but it can be a lot more if we're making a lot more money, right? I've had clients that I've worked with that it's been 10, 20,000, $30,000 per year, right? So this is very impactful, a very impactful tax strategy. You can still do it. That's the key. And a lot of accountants don't know that you can actually go back. And I can say, like we intended to be an S corp as the beginning of this year, we just didn't make the filing on time, right? You can actually go back. There's rules that allow us to go back and say, hey, as of 1/1, we wanted to be an S corp. We just didn't know that there was a deadline. And so that the IRS gives you that opportunity to go ahead and go back. You can actually go back years if you haven't filed your tax returns. You can go back 2 to 3 years, file an S corp election. It's going to save you a bunch of money in taxes. That's one big opportunity, especially for recruiting owners that a lot of tax accountants miss. A lot of accountants miss in general, right? Other things that I get asked a lot, especially this time of year, we start talking about estimates and quarterly estimates. And I like to make sure that people understand how, the quarterly estimates work, penalties work. So if you owe some money in taxes that is not getting normally withheld from your paycheck, or you don't have a paycheck, right? You're a sole proprietor owner. You have this paycheck, you have this money coming out. That money needs to be taxed, right? And the IRS wants its cut. They want you to pay within a certain time period, right? So they want you to pay over these 4 quarterly periods. You're technically required to, but the penalty for not making those payments is a penalty, right? And that penalty is actually super low because it's really hard to figure out how much you owe in taxes especially if you're a new business owner, or even if you're a used to business owner, you've done it for 3 or 4 years. It's very hard to target exactly how much tax you're going to have to pay, right? So the IRS knows that. And so the penalty for not paying in a certain portion of it is actually fairly low. Let's say you owed $20,000 over the whole year, right? If you didn't make a single payment, single one of these quarterly payments for the whole year, what is it that you owe, right? It's usually around 3% penalty. So you basically had $20,000 over that entire time period that was technically the IRS's money that you were able to keep for the 3% interest rate, right? So it's only going to cost you $600 to hold on to it until April 15th, right? So a lot of people will get worried and they say, hey, I need to make a quarterly payment. Yeah, you do. You can. But you need to understand that it's not a huge dire situation that the world's going to burn down around you if you don't make the quarterly payment within a certain time period, right? It's just going to cost a little bit of money that you don't have to pay. I've heard some of my clients call it the stupid tax, right? But it's just a little bit of money that you'd have to pay if that was the scenario. So a lot of people don't understand how we get the money because, like we say, they're like, how much do I have to pay in taxes? Why is it not the exact same every single time? And why am I not completely paid out by 4/15 by the next year's due date, right? Well, there's 2 ways to pay quarterly estimated taxes. If you want to pay the minimum, you do the safe harbor, right? You pay the safe harbor taxes. For most people, we're going to assume that most businesses are on a growth kick, right? They're going to keep growing and growing, right? So the IRS assumes that as well. For most people who are within certain income ranges, there's going to be a factor there, right? So if you looked on your prior year tax return, you see total tax line, right? That total tax line. And if you've had it prepared by another accountant in the past, you can figure this out by just going over to your return, look at the total tax. Let's say the total tax is $10,000. Actually, I probably use $20,000 because we have to be within a certain AGI. Let's say it's $20,000. Okay, 1.1, so 110% of last year's tax, that's the safe harbor, $22,000 divided by 4. That should be your quarterly estimated payment, right? That's the safe harbor. That's the one, where the IRS says, as long as you pay this amount, we're not going to charge you any penalties. That's what that safe harbor means, okay? There's also the annualization method where you try to hit it. You try to hit that actual tax number. It's very difficult to do. And a lot of people are experiencing that this year because incomes went down for the first time probably in a while versus our normal up because of COVID. So I did just want to kind of explain that to a certain degree.